Hey guys, welcome back to Rough and Stitch Options Trading. Now, most beginner option traders, they lose money. And that's a fact. And I know that because I blew my first and my second trading accounts just like that. Not because trading was or is impossible. Back then, I was guessing a lot. And the market exposed that very quickly. I remember my first options trade was Tesla, and I decided, you know what, I'm gonna trade Tesla earnings. Yes, I thought it would be easy money. I placed puts, I lost. Next, I decided to chase a big move with SPY weekly puts. I lost again. Then to make it even spicy, I decided to trade pins right after earnings, right at market open, and the stock moved further up against me, and I got stuck in that position for months. Yes, I married that position hoping it would drop. And guess what? It never did. By the time I was closing that position, it was another big loss. And eventually, because I was just trying my best and trying every way to make it big, I decided I'm gonna do the classic beginner mistake, a Hail Mary trade. I decided to buy 1 cent option contracts hoping for a miracle move, and guess what? It never happened. Those contracts, they expired worthless. Zero. Not even anyone, a single buyer in the market wanted to touch those options contracts. And that's when I realized something. I wasn't trading, I was just gambling. And that's how I ended up blowing 2 accounts. After that, I seriously thought maybe trading isn't just for me. And like many beginners, I started guru hopping. One Discord server after another, one strategy after another. Today I was scalping, tomorrow I was intraday trading, the next day I was day trading, anything. Did it work for me? No. And it took me years to come and realize the problem wasn't the market, it was me. I had no framework. I was like a windsock, blowing wherever the market pushed me. My goal was just make money fast, quick payouts. You see, I was watching everyone on YouTube make it, and they made it look easy, honestly speaking, but the market always finds a way to humble you. And it humbled me very fast. So, me to you, before you start trading, ask yourself this question. What type of a trader can I be? Because there are different types of traders out there. You have scalpers, they move extremely fast. I know some very good scalpers and they move in minutes. You have day traders, they move quickly as well. They hold positions maybe for a day, a few days, a week. And you have the usual swing traders like myself who move slower. Trades can take days, can take weeks, sometimes can take months. Some call that boring, but for me, swing trading worked. And once you understand your trader personality, you can build a system that actually fits you and your style. Now, let me repeat that once again. Once you understand your trader personality, you can build a system that actually fits you and your style of trading. So in this video, I'm going to show you my 5-step framework I use before entering any swing options trade. And later on, I'll walk you through real trade examples so you can actually see how everything fits together, because once you follow a structured process like this, regardless of whether you'll become a scalper, a day trader, a swing trader, trading will stop feeling like random and start becoming a game of probabilities. So, guys, here's my 5-step framework, because in every trade that I enter, I check for 5 things. I know you guys have been checking out my nice PowerPoint here. So let's go right here. The first step is market context. The second one is a stock selection. The third one is a chart setup. The fourth one is the options selection. And the fifth step is the risk management. Now, all these steps, they intermingle with one another. One step cannot perform better than the other. They all need to be there. And if one of these steps is missing, I don't take that trade. It's as simple as that. Because you have to have a plan. If you don't have a plan, you have to start developing a plan, a trading plan for yourself. And then you incorporate these steps in your trading plan. And if you're someone who wants to approach trading with a system instead of gambling, then this channel and this video is for you. So let's go ahead and look at step number 1, the market context. Now, the most important thing is to understand the type of market that we are in. I call that market context. You want to check out, are you in an accumulation phase? Are you in a trending phase? Or are you in a distribution phase? You need to know those three things. What level are you in? Because if you're in accumulation is always down here. Let's find my mouse here. Oops, right here. So you've gone through a downward trend. You start accumulating right down here. And I'll show you that on a chart. You start accumulating. The market starts trending. And then you get to the stage of distribution. This is where we currently are, if you're wondering. And in a accumulation and distribution, the market is always moving sideways. That's just a plain old fact. The market is always moving sideways. Now, there is a famous saying in trading that everyone makes money in trending markets, but many traders, they lose that money in choppy markets. We are in a choppy market right now. And if you started trading in a choppy market, I understand. It is hard. Yep, it is also hard for me too. But the good thing is that you now understand we are in a choppy market and that's just how it is. Now, understanding that concept can help you avoid a lot of bad trades. And I'm not saying you cannot trade in an accumulation or a distribution market. I'm just saying you have to have very good risk management in place to do that. Okay? So let's go to step number 2. That is stock selection. So for me personally, once I understand the market that I'm in, I start scanning for the stocks. Now, you can use stock screeners. They have them out there depending on the platform that you're in. If you're using Webull or Thinkorswim, they have stock screeners. You can use those. And you can also tweak it to however you prefer. So, if you are trading moving averages, you can tweak it to look for stocks that are at certain moving averages. For example, let's say the daily 21 or the 50 or the 200, you can tweak it or you can tweak those parameters in the stock scanner. For me personally, I'm always looking for things that have relative strength, they have increasing volume. Let's come here. They have increasing volume and also the price, they have a clean price structure. And at times you can also see some signs of institutional activity. For example, if you check the options contracts, you can see, wow, you have very high volume coming in, or you can see huge volume candles, all that stuff. Those are things you look for when you're selecting a stock to trade. Now, when you screen and you select a stock, when you're using the stock screener, that will help you reduce, because you have thousands and thousands of stock. That helps you reduce those number of stocks to a small, manageable watch list. And trading becomes much easier because now you're focused on the right stocks and what to look out for. All right? So, step number 3, it's the chart setup. Now, this is where many traders at times they make big mistakes as well. They anticipate the move instead of waiting for a confirmation. For me, I only enter when price action confirms the setup. If those signals aren't there, either number 1, I'm going to wait. If there's no setup, there's no trade. And a key thing here to remind ourselves is that patience is one of the most important skills in trading. You need to be patient, because if your mind is always like, I have to make money today, I have to make money today, that analogy is really going to lose you. Because in trading, there are days when there is no setups, then it means there is no trades. Because if you start looking for things that are not there, the setup is not there, then you're just setting yourself up for failure. That's just a fact. All right, guys? So, number 4. Before I go to number 4, there is this, I purposely put this chart here because at times I see, when I started trading, there was so much I was learning out here. When I was busy guru hopping from one group to another group, so many things, it was drinking from a hose. A lot of information going through. There were groups that, they traded everything and everything under the stars. There were groups that traded who knows what. I don't know. Just a lot. But if you're a beginner trader and you've seen this out here, just know, knowing the information is good. I always say learning is a very good thing because, that's why we have brains. You have to learn. But when it comes to real-world application, you don't need to trade all these patterns that you see out here. Because that's exactly how I felt when I started trading. I was like, well, this is a bearish top. I'm going to trade that bearish double top. I'm going to trade this pennant. Okay, let me see. Okay, I found a bullish flag. Let me trade that bullish flag. No. If you just started beginning trading, or you started and you're still trying to find your way, find 1 or 2 setups and become efficient, effective in those 2. If 2 is a lot, find 1. If you decide to be a breakout trader, if you're trading bullish flag patterns or bullish pennant patterns, stick with that. You don't need to trade everything out here because that's the mistake I made. And that's how I lost money. Because number 1, I was over trading. How can you look for all these patterns in the stock market? I go to Amazon. I'm like, okay, I see a bullish flag. Okay, I also see a bearish flag. Okay, I also see a bearish pennant. You can't trade everything. You have to make this simple for yourself. If you decide to be trading bullish flag patterns or pennants or breakouts, stick with that. Make that process efficient for you. Find out how that pattern is going to work best for you. You don't need to trade everything under the stars. No, you do not. Because that's when you start overcomplicating things for yourself. And there is no need for that. Keep it simple. Because simple is what works. So I hope you guys get that part. Don't overwhelm yourself with so many. Stick to one thing. Make it effective, efficient for yourself. And always look for that pattern in any stock that you're getting into. Tell yourself, if it doesn't have what you're looking for, move on. If it doesn't have this, move on. If you find it, trade it. It's as simple as that. Now, let's go to step number 4. That's options selection. Now, when it comes to options selections, it's important to understand the option contracts and the option chains. And this is where beginners lose money as well. Because, yes, you may have the right direction, you may be bullish on a stock, you may be bearish on a stock, but you can still lose money on that. Why or how, if you're asking yourself? Number 1, either you decide to choose expirations that are too short. You're expecting a big move. What I mean by that is that you are expecting a big move, but you decide to say, okay, well, I'm going to do weekly contracts expiration. But you want this big move, but you're choosing such a short time for that big move to happen. So, 3 things, how you can lose, even if you're right, how you can lose money. Your expiration is too short. Your strike is too aggressive. And by that I mean, either going way out of the money. Let's say a stock is trading at, for example, Amazon is trading at $200 and something, and you decide to choose a strike that's $300. I mean, that's just too aggressive. Number 3, implied volatility is too high. So those 3 things, even if you're right, they can still lead you to having losses. So the options contract must match the time frame of the setup. If the trade needs time to develop, like I said, the option needs time as well. If you want a big move, then give that trade time. Don't have weekly expirations, but you want the stock to move $20, but you give it 1 week to make that move. It's not going to happen. It really is not. I like to show this because it's really interesting. Options are not gambling, but most beginners use them like gambling. This really reminds me about how I used to trade. Responsible options trading is not a roll of the dice. I mean, this really makes sense. And a lot of people, they take it, they even don't know they're gambling, but that's exactly how they're trading like. And options are not gambling. All right, let's go to step number 5, risk management. Now, I talk about risk management a lot. I feel like a broken record, but I still have to keep repeating it because this is a step that actually separates traders who survive from traders who blow up their accounts. When I started trading, honestly, I even didn't have a clue about what risk management was. That's just how bad it was. I had no idea where to put my stops. I just knew, when I enter this position, this is what I'm expecting. But I never took the time to really know, what if this position goes south? How much am I losing? If this position starts going against me, where is my stop loss? I didn't have that. And I blew my account 2 times because of that. So, me to you, before entering a trade, you need to know what your maximum loss is. You need to understand position sizing because a lot of new traders, they mess up this portion of position sizing. You're either positioning yourself too big and you don't know what you're doing. You're positioning yourself too big. You don't know where your stop loss is, so you need to know where your stop loss is going to be. If things go south, you need to know what you need to have known before that where your stop loss is. And as I always say, I know it's the bitter truth, but if you don't know these 3 things, then you're probably gambling. That's just true. If you don't know your loss, if you don't know how to position yourself well, if you don't know where your stop loss is, then you're gambling. Because I like to remind myself this. And through the years, I keep reminding myself, trading isn't really about being right every time. It's really about managing your risk over time. Because if you have positions that go down 50%, 60%, and you have winning positions where you take profit at 10%, 15%, when are you ever going to make up for the 60% loss that you took? Just think about it. If your losing positions are in the 50%, 60%, 70%, and your winning positions are 10%, 12%, 15%, how are you ever going to break even? The math is just not mathing. That's just a fact. So those are the 5 key things. And just before we continue to the real trade examples, by the way, if you're finding this information helpful, consider subscribing to our channel, because this is where I break down things like this step by step so you can see exactly how the process works in real market conditions. Now, let's go ahead and look at Amazon. I'll look at 2 trades, Amazon and UNP. UNP is a trade we took. I'll just look at it once more, but let me look at Amazon also as a trade we took some time back, because I haven't been trading that much because of how the market is. Now, this is a trade that we took in December. This was in November. I entered this trade in December just because on the weekly time frame, I did see a setup that I really like. So this accumulate, it's like a consolidation box. I like these consolidation boxes either two ways. If they happen at the bottom here, I like this type of consolidation boxes like that. I really like that. After a downward trend, it consolidates. You see how it picks up to an upward trend? I like that. Now, the same thing happened right here. You can see Amazon was consolidating from, this one was 17th of November all the way to the 29th of December. And then it took off with this candle here, breaking this previous resistance, breaking that and moving to the top. Now, this is a position that we took. And I took this position because it dropped right here. Let's draw this. This thing dropped like that. It consolidated right here. And I want you to see something very important here. It was consolidating on the weekly 21. Now, look at the support. It was not breaking this support here at about 224.91 cents. It was not breaking this support right here. So I got some Amazon calls, and I want to show you the risk reward for that, because I like doing that so I know, is a trade worth it or is it not worth it? Now, for this trade, I was really hoping that we could go to the previous all-time high, but we did not go there, and I was very keen, eagle eyes on this trade because the market context, we've been trading sideways since October, so that was something that was on my mind for the trades that I was taking. So my stop for this one was basically, let me make sure. I got into this trade right here at the weekly 21. And I exited that trade at 247, about 247, yeah. Because I know this following week there was CPI, I think CPI or PPI. So I exited that position because I was, I think, 80% up on this trade. So I didn't want to lose my money on that. So I exited this trade right on this week. This 12th of Jan week, there was CPI or PPI, one of those. And I exited this trade on that Friday. CPI, PPI was the next week. Now, you can see this trade was My stop was right about there. Sorry, slightly below. So my stop was just about there, and it was a 1:6 type of trade. And it was about 85%, something like that. Anyway, what I'm trying to say is that sometimes you have to draw these types of things. So number one, let's go through the step that we are talking about. Number one, you have to understand the market concept. Let me put these things right here and we can go through them one by one. Just copy this so I'm not moving back and forth. Paste it right there. So number one, we've talked about the market context. Understanding the type of environment that we are in. And the market context, when I talk about the market context, let's look at QQQ. This is what I'm talking about. This is where we are currently. You can see we've been trading sideways since October, just trading sideways. We are not making any new all-time highs. No, we are not breaking that support. It's just a range going nowhere. This is distribution. Down here is accumulation. Down here we have accumulation. Here we have a trending market because we are making higher lows and higher highs. We are making higher lows and higher highs, higher lows, something like that. I hope you get the full concept of that. But yeah, we have accumulation down here. You have a trending market making higher lows and higher highs, and we come into a distribution. Accumulation and distribution, both of these, the market trades sideways. You can see also down here, the market trades sideways. Oops. So right here, the market just trades sideways. But you see again, you see the concept, higher lows, higher highs, higher lows, higher highs. We come to a distribution, we drop, we come to an accumulation, we start. Higher highs, higher lows, like that. We come to this step again. So it's the same, it's the same thing as right here. Same thing right here, okay? So understanding the market concept. And these are the areas I keep saying. These ones are very difficult to trade because it's just chopping around, up and down, up and down, up and down. You enter a trade today, you're green or you're red or you're who knows what. Tomorrow it's the opposite. It's the same thing going on right here. So that's why I'm saying if you started trading about October, that was the end of the bull cycle, late stage bull cycle. So now we are in this choppy range distribution right here. And it's difficult. And I understand because I'm not trading also as much as I used to when the market was trending. So let's come back to Amazon. Now, same thing here as Amazon. I found this nice accumulation. The weekly 21 was not breaking right there. Entered this trade. We already did the stock selection, Amazon. So the chart setup, accumulation right here. And I want to see what is my risk reward in this. If I enter this position, what is my risk reward? So something like that, you just draw up something like that. That's how you know. If your risk reward is 1:1, that trade is not. If your risk reward is 1:1, that trade is not worth it. You have to go higher multiples. That's how you're gonna make money. So the chart setup, if you're trading this, if you're trading breakouts, that's what you stick with. Those are the only two things that you're looking for. Plain and simple. Like I said, you don't need to trade all the double tops you see. You don't need to trade all, let's come back here. You don't need to trade all the double bottoms you see. You don't need to trade all the bullish falling wedges. Oh, sorry, this is not supposed to be village. But anyway, you don't need to trade all the bullish expanding triangles and You don't need to trade all that. Okay? If this is the setup, this is what you're looking for, consolidation breakout or breakout patterns, just trade those, stick with that, trade those. Don't make your life complicated. There is no need of doing that. So this trade ended up being a 1:5, like I said, about 85% up. That was it. Right here, exited the trade. It was CPI, PPI, one of those. Just exited that trade to avoid losing money if things went against me. Now, let's come to options selection, because this is also a very key aspect that a lot of people make a mistake in. Let's come to my account right here. Same example, we are looking at Amazon. So Amazon, let's come to the option contracts. Amazon, right there. Let's come to the options. Now, if you are expecting such a huge move, as I said before, you cannot give your contracts 1 week expiry. You have to give your contracts a much longer time, a month at a minimum. You can't expect Amazon to make, who knows, that is what, this is about $10, $13. You can't expect Amazon to make $13 in a week. I mean, yes, sometimes it happens, but not all the time. You have to buy time. Not saying, okay, well, I'm going to trade next week's expiry. That's good for me. And I'm going to open Amazon 240 calls. It just doesn't make sense. And that is where people make mistakes, because they're like, okay, well, I'm going to buy options contracts. Well, this side is calls, this side is puts. And you go like, I'm going to buy Amazon 240 calls. They are 6 cents. I'm going to buy 100 of them at 6 cents. If this thing decides to go south, this 6 cents will very quickly become 1 cent. Remember my Hail Mary trade? Yep, that's where you'll end up being. And when they become 1 cent, nobody is going even to touch those options contracts. They're going to expire 0. So you have to select the options contracts very well, in a manner that's good. Give them time. If you're expecting a big move, and that's the thing about swings options trading. If you're expecting a big move, then go further out. Go further out. So for example, Amazon right now, it's at maybe $212. So you decide and say, well, let me look at the calls of 18th of June, how much, let me see how much they are. Let me look at the volume and all that. Let me look at all that stuff. And that's when you decide either, get something or get a contract or 1 contract or 2 contracts, as compared to going way out of the money that even delta, because that's the other thing, you have to look at your delta. If your delta is 0.05, even if that stock moves $100, I'm kidding. Even if that stock moves $20, $30 up, you're not making any money because your delta is down here. So you have to have an understanding of options contracts, options chains, expiry dates, delta, and theta. Because again, look, let's see if this is gonna. So look at this 20th of March expiration. So let's say you even go with a call of 215, a delta of 36. Look at the theta decay is 22. That's not good. That's very bad. So if you want to eat up a big move, a big chunk of that, go further out. Look for a good delta. Always look at the theta, because you want the theta to be extremely low. The theta is a theta decay. You want that to be down. You want your delta to be up. And stop. Don't go out here 280, 300 calls for 1 cent, because you will end up with pennies, zero, nada, niche, nothing. That's how you're going to end up. So, we've looked at the options selection. Now, let's come to the risk management. I think I've discussed this under risk reward. Understanding what your reward is, but also understanding what your risk is. Because at times I see some of my new students and I understand it's a learning curve and I've been there. And that's why I'm doing this video to showcase this to you as well. You just started trading and you put your stop loss right here. Now, look at your risk reward. It's 2. Because you're letting this stock fall way behind. You're losing delta, all that stuff. Theta decay is increasing, and then your contracts are just getting chewed up. You have to set up tight stop losses, reasonable stop losses. Because if this thing decides to go south on you, you just cut it. All you have lost is just a tiny fraction as compared to what you will gain. Because, like I keep saying, I don't care about the number of times you're right. It doesn't matter. What matters is your risk reward. What matters is not how many times you're right. No. What matters is your risk reward, because you can take one trade and it ends up being a risk of 1:12. And you get good money from this, and you don't need to, waste time looking for. No, you can take a breather. And that's the key thing. Understanding risk reward, I keep insisting on this because some people, some new students I have, they go like, well, what's your win percentage? I go like, well, I really don't care about the winning percentage. It doesn't matter to me. What matters to me is your risk reward. I want you to risk 1 and get 3, 4, 5 reward multiples. I don't care about 90% win rate. I don't care about 100% win rate. Nope. No. I only care about risk management, and I only care about risk reward. Because that's what matters the most. So I hope this example makes sense. UNP is a trade we did. I won't go through that. Same concept. This stock has been was accumulating right here. This was a previous resistance for so many times until it broke it. Your stop loss just right above, this is going to be too tight. Right here, if your stop loss is at previous resistance, that's too tight. Go just a little bit lower. And then your risk reward is that previous all-time high. I mean, it got there. You can see it got to about 257. But yeah, this was a trade where I personally got 211% out of it. So that's why I'm saying win rates 90%, 100. Who even knows? Some will come up with a 200% win rate. It doesn't matter. What matters is your risk reward. That is all that matters. So we've done a recap of all this stuff. Amazon. We've done a recap of my 5-step that I make sure I have on point before I trade, the market context, understand that your stock selection, your chart setup, your options selection, and your risk management. Because if you skip any of these steps, then one of them will fail and the whole framework is gonna fail. You won't be trading, but you will be gambling for sure. Anyway, that's all I wanted to share. Now, if you want to get better at spotting these setups yourself, consider subscribing to our channel. I try really, really hard to break down real trades and show you the education behind all that and compare that to the real trades that I've actually taken and I'm actually showing you how this framework applies to these real trades. Because I can sit here and talk about what and what, but it won't make sense until I show you real world setups. And that's what I'm doing right now. And it becomes easier for even you to recognize these opportunities yourself. And remember the key thing. There's a difference between gambling and trading. And it's having a framework to trade. That's all I have for tonight. Thank you guys for watching, and I'll catch you on the next one.